You're listening into the Everyday Investor Podcast. Passive investing, property investment, managed funds, and crypto. If you're an everyday person wanting to build new wealth for the new world that you're heading into, then this podcast is for you. I'm Darcy Ungaro, your host. I'm a qualified financial advisor, but I'm still learning how to invest better and teach others how to do the same. I talk with guests and cover a range of topics designed to get you to think for yourself here. But please keep in mind, this can't be considered financial advice. Be sure to do your own research here and seek qualified advice of your own before making investment decisions. If you want more information, check out the show notes in your podcast player and make sure that you've subscribed to YouTube also. Then follow the Everyday Investor on all social media channels. The NZ Everyday Investor Podcast receives support from the following partners: Easy Crypto, the safe and easy way to buy and sell crypto in New Zealand; Gorilla Technology, increasing business success through innovative and strategic IT solutions; Ungaro & Co. Financial advice for everyday people building everyday wealth. Hope you enjoy the show. Let's get started. Hey everybody, and welcome to the podcast. And welcome everyone to what happens when you go away and then come back home and try to kickstart all the normal patterns like podcasting and interviewing guests and booking in a few conversations in advance. So it's just me today and a mental hack that I want to bring to you, the Everyday Investor, that can hopefully help provide some automated guidance whenever you're in over your head or whenever you want a real simple guideline around how you should be investing. And to those of you who are new, and I can see you out there, thank you. Thanks for listening in. Welcome to the podcast. Apart from interviewing guests, occasionally I flip things around a little bit and I'll share a view, which is what's going to happen today. And usually it's inspired from previous discussions I've had with guests, and I'm trying to string a line, I guess, between what I think I see coming in the future and what I imagine an everyday person would be interested in learning about. Over the past 5+ years, I've produced around 400 episodes of this podcast. I've learned a ton of stuff, but the best news for you is that I'm genuinely a slow learner too, and I may never catch up to the really, really smart thinkers in the investment space, but you should hopefully catch up to me eventually, which is good because we'll be able to hang out for a bit and share a little bit of stuff back and forth. If it's your first time though, using your thumbs while you're listening to a podcast, I'd encourage you to find a way into the show notes of this episode if you can. Subscribe to our monthly newsletter. It's my way of sharing insights that I think you'll value, delivered in a refreshingly irregular and occasional manner too. And don't miss the YouTube channel for extended versions of the interviews. Now, a note of caution, remember to approach online content, talking about health, talking about wealth, with a healthy dollop of caution, including this episode, including this series. The entire wealth and financial services industry is littered with commercial tentacles and public voices all trying to influence where your money goes. We're all selling something, even if it's just an opinion, so just be aware of that. Listen to a few voices if you can, just to rule out some of the risk that you might be getting carried away with one style or technique, and take your time when making big investment decisions. Ideally, get some advice if you can. Now, the bulk of this podcast is normally about me learning and writing and sharing about what I've gone on to learn about to build wealth in a way that's aligned with my view of where the world's going. The rest of the podcast, though, well, that's just a little bit different, and that's today. We all interact with finances in some way, though. Owning a home, having a bank account, maybe investing in shares or managed funds, but without the tools to visualize your financial world, you're not going to know where you're at times, and you're not going to know where you're going as easily, and you're not going to know where you're going to end up. It's going to be hard to model. So you might perform some sort of portfolio tracking thing every now and then. Maybe you use a spreadsheet, but if you don't like that format or it feels too stuffy or you're always missing something, then you could consider a tool like ShareSite. It's been something I've been meaning to talk about for ages because I went through a whole bunch of trouble a while back getting set up with an affiliate code just so I could offer as much free months to you as possible, and I've got that. So if you want to look at all your investments in one place, you want to get feeds set up by the online brokerages directly into a platform, and you want to track where you're going to be at some point in the future, then in the show notes is a link where I've arranged to get you 5 months off for all new signups for ShareSite. So definitely would recommend that you check it out. Some people love it, some people don't. So you do you, right? Now, if you're like a lot of people, though, you may go about investing here, there, and everywhere, and maybe with your KiwiSaver largely on autopilot, you're not likely following any particular framework or strategy. Sure, you would have made some decisions at some stage, but to a certain extent, it's kind of just all bubbling along, right? Now, you don't have to do anything about it, of course, but if you did, you have a few options on how you can move towards a little bit more structure. And today, I just wanted to share what I think is something really simple, and it's mainly for those of you that are bumbling along a little bit at times, and you want to get rid of that sense that perhaps there's a bit of structure missing, and maybe we should do something about it. So some of the episodes that I've recorded over the last month, and a couple that I have coming up, have really fired up my imagination around where things are going to be at some point in the future. And it's really the technology bit and the potential for massive deflation as a result that has me really fascinated. So if it's okay, I want to just briefly start with that and then move on more towards this strategy that I want to talk to you about, because it kind of is a way to accommodate what might be happening in the future without betting the farm on it. So it's easy to become anxious about AI, artificial intelligence. It's easy to get a little bit concerned at times around how fast it seems to be advancing and encroaching into your area of employment potentially. And if you want, I would totally recommend that you choose optimism if you can about where the future's going, instead of pessimism that we're being replaced by machines. It's hard to imagine the kind of mass unemployment that could in theory be possible if the rate at which that type of technology does expand, especially if it happens at a rate which is higher than we're expecting. But most probably there will be some time to adapt and to shift lanes with how we work and what we do, carefully allowing for an infusion of tech to enhance our capabilities rather than replace them. But personally, I think that in a way, the battle of the machines and humans, well, maybe it's already been won, right? The machines have actually already won. And the fact that we're still standing, well, that's kind of cause for celebration in a sense, or even just optimism, because maybe the future ain't all that bad after all. Sure, once my job is replaced, maybe I might feel differently about the future, but still, I think we should be hopeful for a positive future, hopeful for a new type of abundance, and an end to crisis and lack of. Now, with the change of pace that's going on, it'll be uncertain for a few years. That, I think everybody will agree on. No one knows how fast things will really change, or if things will really change that much at all, really, but definitely going to be uncertain about how things, unfold over the next little while. The technological evolution may change the way that we go about investing, though, and it might even change the reason why we invest, and it may also change the things that we invest in when we do it. The next 7 years are going to be really interesting when it all starts, but in the meantime, we still have to make good decisions with our money, and ideally, we still need to invest using best practice techniques that exist for the present and that have worked in the past. We need to be investing like we always have done, but we have to accommodate a new future also. So to visualize your portfolio or your collection of investments and to partition your portfolio according to the already and the not yet, well, these are two really good reasons to implement a couple of simple rules. Trusting what we've always done may be fine to a point in terms of how we invest, but at some stage, some of the current mega trends are going to have an impact on our portfolios. Heightened environmental concerns, societal upheavals, geopolitical realignments. They either kind of go away because there is nothing to them at all, who knows, wishful thinking, or they get more intense. Should we wait for an apocalypse of sorts before we really start investing? Or should we recognize that fear never really generates a positive return, so we should probably just stay invested all the time? Lastly, though, there's an ever-present tussle between the concentrated investment strategy, and the diversified one. Focus on investment properties alone, or focus on just building a portfolio of handpicked shares using a rigid valuation-based selection process. Aim for outperformance in a specific niche, or hedge your bets with a broad range of investments. Invest a little bit in a lot, spread your risks out, sacrifice the opportunity of outsized gains, but get a more predictable rate of return over time. Or do the opposite. It's really up to you. Maybe you can do both. The diverse centration tension, if you genuinely understand the benefit of both, needs a framework. And that's where the meat and 3-veg paradigm kicks in. So think of your investment portfolio as a dinner plate. I always imagine what it would be like in prison. Not too much, just the food, right? And just thinking about that tray that they probably get their food put into. Maybe there's a couple of little indentations for the different portions of food according to just, I don't know, how much they're supposed to eat for a balanced diet, right? I would imagine a large portion going towards meat and maybe 3 little indentations for the different portions of vegetables, carrots, peas, and, I don't know, potatoes. So imagine one big helping of meat on this investment plate. That's basically representing core style investments. Then on the side, we have 3 concentrated helpings of vegetables, symbolizing, say, a small portfolio of specific shares, investment properties, or other concentrated style or speculative investments. This meat and 3-veg methodology can be a simple guide to categorize and visualize your investments. We're using a style of investing that's worked in the past, but we're also accommodating a position which can be tilted for the future that you can see. Another way of saying it is that we're simply just allowing for the deployment of both a diversified and concentrated strategy simultaneously. For most, maybe a 70% allocation of meat or core investments would be a good idea, and maybe 30% for vegetables, the concentrated investments. Maybe that's a good starting point. Of course, you can do anything you want. It's investing after all. You can go higher or lower or play a different game altogether. There's always flexibility, and there's more than one way to get it done. 50-50, 60-40, 100%, either way, whatever. As long as you have some sort of strategy, that's the main thing. Now, I like to think of my meat as a sausage, and forgive me, I know there are some out there who are not a fan of the sausage, but hey, it's ground up meat, right? It's a sampling of a very broad selection of different parts of the animal, right? So it's kind of like analogous to a managed fund, which invests in a lot of little companies inside of it. And it's an easy way to tackle diversification all at once. So sausage, yeah, that's my style of meat because I believe for the most part in diversification. Managed funds like what you'd find in your retirement account, like KiwiSaver here in New Zealand, or perhaps even some exchange-traded funds or index funds that provide access to a broad range of asset classes and a broad range of jurisdictions. That's kind of what I like to have in the bulk of my investment portfolio. Now, my 3-veg are U.S. shares, so a small portfolio of U.S. shares that I own directly, and then shares in directly held private businesses, investment properties, gold, and Bitcoin. So I have a few vegetable platters going on there, I guess. You can have one, too many. It's really totally up to you. Now, my goal is to make the sausage part of my plate about 70% of all that I invest in, and the other parts can be relatively small. This way, I know I'm going to get at least an average rate of return on the majority of what I'm investing in, but I also have small investments in some key areas that I believe will be successful in the future, probably because of a lot of things that I can't really control myself. Now, some of us get really bored pretty fast with the meat, and we rather focus on the vegetables. Pink Floyd has the answer here, right? If you don't eat your meat, you can't have any pudding. Sorry, I can't do that in his accent. But perhaps it's a sign, if you think like this, that you should take a closer look at diversification if you are kind of turned off by it. Maybe a little bit of it could be good for you. Then again, you might be too interested in the meat. Maybe low-cost, passively managed index funds can really appeal to you, but maybe you don't have to be a vegetarian to try the salad. There's always room for another perspective, though. Now, by the way, for those of you wondering how to access index funds and managed funds, apart from just optimizing your KiwiSaver plan, there are a few options here in New Zealand. You can access Invest Now, Flint, or you could access some of the cool options through financial advisors that they have access to. There are a few tax bits to consider, but you could also even target exchange-traded funds through your digital brokerage account like Sharesies or Hatch or Stake here in New Zealand, or TD Ameritrade or Robinhood in the US. Links to some of those platforms are in the show notes to sign up if you want to try those platforms out. So, like I say though, it's a really short one today, and that's pretty much it, as I just have a gap to fill in, and why not share a few thoughts. Half the time, I'm going to be learning with you as I talk to much smarter people like me, and the other half, I'm just going to share a few views like this. It's how I learn, so hopefully you'll be learning along with me for a little bit longer here. Now, if you want to learn more about this strategy, check out the lessons in the New Wealth Foundations course. It's a personal finance course that we created for the everyday investor to get up to speed fast with just the basics. And on that, we have another course for those interested in optimizing KiwiSaver. That's right, fellow financial advisor Carly Ellis and I, along with some people from some KiwiSaver providers, have all helped out to cook up the KiwiSaver Millionaire Roadmap. Which types of funds perform the best, the other strategy your KiwiSaver provider never tells you about, how much you have to invest to get to $1 million or whatever your goal is, and more. Take the course, it's good for your sausage. Then complete the lessons, and you'll get a free 30-minute KiwiSaver consultation at the end with either Carly or I. Now remember, it's free, and it won't make you poor. 2 really good reasons to do it. Hit the link in the show notes to enroll. Now that's it for this episode. I hope you have a fantastic week, everyone. Next week is going to be amazing. Actually, the next couple of weeks is going to be amazing. We've got a really good couple of episodes lined up for you. Looking forward to having a chat with some extremely smart people. Have a good week, everyone. Stay positive. Catch you next week.
Thanks for listening into the Everyday Investor Podcast. Like what you've heard, but you want more? Make sure that you've subscribed to our YouTube channel and subscribe to the Everyday Investor newsletter too. The links for everything are found in the show notes that you can access easily by swiping or tapping over the cover art in your podcast player. If you received value in some way, I'd love it if you could take the time to write a review wherever you listen to podcasts. Share it with a friend, or think of our show partners where appropriate. Easy Crypto, the safe and easy way to buy and sell crypto in New Zealand. Gorilla Technology, increasing business success through innovative and strategic IT solutions. And Ungaro & Co. Financial advice for everyday people building everyday wealth. Remember, some investments or strategies discussed on these episodes may result in financial loss. Be sure to do your own research and ideally seek qualified advice of your own before making investment decisions. Hope you enjoyed today's episode, and we'll catch you next time around.